So we came into work, they're handing out bags of Lay's potato chips. And the nutritional facts were something like complete and honest feedback, totally anonymous and confidential. We want to know what you're feeling, what you're thinking.
Corporate fraud works best in the shadows, behind corporate walls. How does the government bring these wrongdoers to justice? Whistleblowers. These are the stories of those who risk their careers to shine a light on allegations of fraud. Today on Fraud in America.
Well, welcome to today's episode of Fraud in America. I can tell you, and I told our guest today before we got started, this is one that I've been looking forward to for many, many reasons. I went to law school. My first day was September 10th, 2001. Unbeknownst to me, of course, down in Houston, there was an accounting scandal brewing about this time. So as I was going through law school, this story broke, and it drastically changed some of my long-term career goals. And I ultimately became a whistleblower attorney in large part because of what happened at Enron. So today, I'm very, very honored to talk to our guest, Sherron Watkins. She's the former VP of Corporate Development at Enron Corporation. We'll talk about today, it really was the jumping off point to so many wonderful things that happen in our world to protect and encourage other whistleblowers to step forward to uncover fraud before it metastasizes into something quite big. So because of her courage, she was recognized by Time Magazine as one of the Time Magazine's People of the Year, along with Cynthia Cooper, who was represented by a law firm that I actually worked at many, many years ago. She was the WorldCom whistleblower, and also Colleen Raleigh, who was an FBI whistleblower who stepped forward. All of that happened exactly 20 years ago this month. So this is really a full circle moment for me. Sherron, welcome to the show.
Well, thank you so much for having me. I'm looking forward to our discussions.
Yeah, this should be really great. But I got to take you back to a town called Tomball, Texas, population 6,000. Can you talk to me about what it was like growing up there? Why that led to who you are today?
Well, I'm glad you mentioned that. The Time Magazine cover with the three of us, Cynthia, Colleen, myself. Obviously we're all women. They called it the Year of the Whistleblower. We've got a lot of things in common. We were the primary breadwinners for our family. We're people of faith. But also we all grew up, the three of us grew up in towns smaller than 10,000. And I think what that does is you do grow up around neighbors, relatives, your parents, listening to them just casually take responsibility for the village. Hey, call the mayor. Did you see somebody dumped all that trash in the vacant lot off of Main Street? That there's this sense that your actions matter. We're all in this together. And I think that infused in us an optimistic viewpoint that basically we could speak up, we could put things in writing, we could address those in power because we optimistically thought, that our actions would result in righting the ship. Now I say, optimistic, but I should say we were naive because I really failed to grasp that when it's almost like you're calling the mayor to let him know that he dumped trash in the vacant lot.
Right.
Failed to realize where you might not want to hear that news.
Yeah, I think you're right, Sherron. As I look back over the last 20 years, the whistleblowers that I've interacted with, many of them come from small towns, people of faith who view that if they see something, should say something, and if that doesn't work, you do something. That simply is the right thing to do for a lot of people, I think, but that doesn't always work out, I guess. So you grew up in this small town. Your mom, if I get this right, your mom had a business degree, and she encouraged you to go into the world of business. Is that right?
Well, she did. She graduated from UT's business school. Back in the 50s, she really wasn't welcome into business. So she became a business teacher at
Wow.
a local high school. But when I had to check a major when I was heading to UT, accounting was near the top of the list. And I would say I just had better things to do and just checked it. It was, she did encourage me that the business school would be, a great place to park myself. The interesting thing now is it is very difficult to get into UT's business school.
Yeah.
You can't just sort of check the major and say, yeah, this is what I want to do.
So off you went to the University of Texas. And while you were there, did you find a love for accounting and business? How'd that all roll out?
I would actually say it was just, it came easy to me.
Yeah.
I could, take an accounting test and just get one thing wrong. I'd make a 98, a 96. So it was kind of easy. And because I did have a high GPA, I was hired by Arthur Andersen in the Houston office, and they were the place to work in the 80s.
Wow. So this is, let's see if I remember correctly. So this is 1981. Is that right? You
Yes.
joined Arthur Andersen. Yeah. And eventually became an auditor. But then you decided at some point to head north of the Mason-Dixon line and join a firm in New York City. Is that right?
Well, in the 80s, if you remember, oil prices dropped to under $10 a barrel.
Yeah, right.
And the whole sector just had this massive collapse. So it was kind of not fun auditing these oil and gas companies in Houston, Texas. But I tell you what, Jeb, sometimes I think I'm a little bit of a jinx. So in 87, New York City was booming. And I was a manager at Arthur Andersen. And I heard through the grapevine that if you just raise your hand and say you wanted to move to New York, Andersen would transfer you there, that they needed more auditors in New York. So I decided to do that. And I moved October 1st, 1987. And like 16 or 17 days later, it was Black Monday. And
right. Yeah.
where the stock market collapsed, the financial sector had a lot of layoffs, so I ended up moving into litigation support at Arthur Andersen. And that was interesting because it did give me some insights, into problem accounting firms that we helped defend, in other situations as well. But after 6 years in Manhattan, I was like, I used to love the city, but now it's wearing on me. Time to get back to my Texas roots. And I thought, hey, when you look around, Enron was the only, place to work in Houston. It was the best, paid the best, most exciting. If you could get a job at Enron, that would be amazing.
During this time, Enron was already the behemoth in Houston. They'd already taken off.
When I actually first started there in 93, Enron's mission statement was still natural gas pipeline related. Mm-hmm. But this was 93, and Jeff Skilling had been hired away from McKinsey in 1990, and he had started the gas bank and was really helping open up the gas commodity trading business, which, Enron really was, a big part of why that market developed. And so we were already being discussed, in Harvard business case studies, Fortune, Forbes were already looking at this gas bank idea and what Enron was doing. So we were kind of getting that most innovative company recognition at that point.
So at some point, I guess your path crossed with Andy Fastow. Can you talk about your initial interactions with Andy? Did he hire you? Is that correct?
Yes, Andy was the one that hired me. So in 1993, the summer of 93, Enron had partnered with CalPERS, the California Public Employee Retirement System. That's a multi-billion-dollar pension fund in California. And they're primarily in the stock market, but they had a small slice of their portfolio that they reserved for alternative investments, things that might bring a higher return. And they had started a 50-50 partnership with Enron. They put in $250 million in cash. Enron put in $250 million of Enron stock. And they formed this investment partnership to do equity investing where you're lending money to or equity investing in an oil and gas company. And part of that requirement, that capital funding, you're asking for the commodity back. You're wanting the oil volumes, you're wanting the gas volumes. So this was also another way to jumpstart the trading. When you have some physical supply, it opens up some opportunities for you. And so that was the impetus for why it fit with Enron and the trading operation. So Andy's the one that hired me because my experience with the commodity finance shop in New York fit perfectly with what he needed for someone to manage this JEDI portfolio. Oh, JEDI, it was Joint Energy Development Investment Partnership. So that's where some of the Star Wars stuff started.
You were perfectly placed, given your experience at all these different stops along the way, to recognize what was actually happening here. Only because of all these other experiences were you able to ultimately connect the dots. It's very
That's
fascinating.
exactly right, Jeb. That is so true.
So in 1996, and I want to slow down at this point because this is an important point of your story, I think. You talk about that you saw the seeds of fraud around this time. Can you talk about what those were and why this is so important to your story?
Well, I appreciate you mentioning that, Jeb, because I think it is an important part to the story. It was the third quarter of 1996, and it had been a really low volatile summer. The trading shop had not made much money. They need volatility to make money. And it looked like Enron's wholesale operations was going to miss their earnings target. And, even as under Rich Kinder, Enron, you just couldn't miss your earnings targets. So there was this whole all hands on deck meeting, and there was a discussion that, okay, we mark to market our gas commodity positions and our oil commodity positions, that are liquid. Marking to market requires a liquid market and a readily determined price. And the idea is that if you wanted to sell this position tomorrow, you could. That's what liquid means. Well, they decided that some of these equity investments that were held within the JEDI portfolio, that those were actually held for sale. They weren't strategic assets. And we should be able to mark those things to market, which really was marking it to a model.
Right.
And they termed it fair value accounting. What is the fair market value of these investments? And I had a very big problem with it because it's not a liquid market. It would take months to sell these kind of equity investments. This is, when a company has to sell a corporation or an equity investment in a hurry, it's called a fire sale for a reason. You're not going to get the true value of the company. And in September of 1996, Enron took two investments that it had within JEDI and wrote them up significantly. One was written up by 50%, just absolutely, not correct. And even if you were trying to argue fair market value, one of the investments had been purchased out of the publicly traded market on early September. And then in 1 month, they're writing it up by 50%. It just didn't hold water any way you looked at it. So I complained, and I even complained to some Anderson partners that were in the Enron office one day. And I really got hosed for it. And it really, really bothered me. And I remember talking to the head of risk management at the time. I said, look, I'm not in the accounting department. I'm not booking these entries, but my name is on the JEDI portfolio. I'm the head, I'm the person managing this portfolio. So this is happening on the assets I manage. And I just don't want my name associated with it. And so I looked to see about transferring. And by the end of that year, I had transferred with a group that moved from wholesale to Enron International. So I got myself away from that activity. But the reason I mention those transactions is they really were the seeds of Enron's ultimate fraud. And in some cases, those equity investments went public. And we had some tech investments. They went high when the tech boom was happening, and they fell down to the floor when the tech bust happened. And Enron never wanted to write things down. And the Raptor fraud that I found in 2001 was a false hedging strategy around those equity investments that had been written up. So to avoid write-offs, they did this fraudulent structure. So, the interesting thing are connecting the dots of the big fraud with the tiny fraud. And that's, I can trace the seeds of Enron's big fraud back to September of 1996.
This is such an interesting story, I think, maybe for some of our listeners. we know without a doubt, since we've started this show, that there's people that listen to this show on a regular basis who are working for companies right now, and they're being asked to look the other way, right? They're seeing some of these seeds of fraud, and sometimes they find themselves justifying or explaining away, it's not that big of a deal. The dollar amounts, it's not that much money. The risk to the company and the stockholders isn't that big. So I think this story is really important, Sherron. This idea that seeds of fraud can grow into becoming massive forest of fraud that can bring down a company. So I really appreciate you sharing that.
Well, and Jeb, you make a great point. For anyone listening that is looking at something small, I am so pleased with the bounty provisions of Dodd-Frank that give whistleblowers within a public company, if they give tips, referrals, complaints to the SEC, and the SEC investigates and fines the company, 10 to 30% of those fines go to the whistleblower. First off, that's attracted legal talent to the support of the whistleblower. You can find legal support, you can remain anonymous. But secondly, it gives an opportunity, another tool, a check and a balance against abuses of power within a corporation. If Dodd-Frank had been in existence in the 90s, I would have contacted an attorney, reported this fair value accounting. The SEC would have come in, slapped Enron on the wrist and said, there's no way this meets any kind of generally accepted accounting principles. This doesn't work. They would have caused them to restate their quarterly financial statements, fine them, and Enron would have been scared straight. And this is the most important point, I think. We should actually be very grateful when you see a small thing within a public corporation. I have an analogy I sometimes like to use. That the word on the street is that serial killers start with the neighborhood cats before they move on to human beings.
Right.
So really, the SEC is catching somebody when they're killing the neighborhood cats. But that's going to grow into worse killings. So we should be grateful when the small things are stopped. And someone bothered by it out there listening, get a hold of a whistleblower attorney, check it out, see what can be done.
Thank you, Sherron. So at Taxpayers Against Fraud, we, of course, have 500 member attorneys from across the country. Many of them specialize in this area. So if it's not reaching out to us, reach out to somebody that can help you navigate these important waters. So one of the things, Sherron, I heard you talk about is that during this time, Enron, the culture seemed to shift from this idea of embracing technical proficiency to embracing salesmanship and cross-selling. And it was all about boosting those numbers. Can you talk a little bit about that culture shift that happened?
Well, that culture shift was at Arthur Andersen.
Oh, interesting.
When I was in New York for Arthur Andersen in the late 80s, I worked 8 years at Andersen. So, 10 years is when you're maybe considered for partner. So I'm bumping up on that partner track, and they told all of us experienced managers that the number one criteria for making partner was if we took away all your clients, all your book of business, that you could replace that book of business in 1 year. So they were telling us that salesmanship, as an accountant, mind you, as an auditor, is more important than technical proficiency, standing up for the rules, making sure your clients were presenting financial statements that fairly represented their financial condition. It became salesmanship, and it's a real shame because Andersen's culture that was so admirable for so many decades shifted in the last decade of its life.
It's interesting that I conflated the two because there really wasn't a dividing line here, it seemed, right? There's this conflict of interest that right now seems obvious, but back then, they're making millions and millions of dollars in consulting fees and auditing fees from Enron. So the idea that they were going to actively push back on Enron seems somewhat laughable now.
It is. Additionally, the sad thing is that Andersen had a client retention policy. It was really to sniff out, a breeding ground for fraud. Or is there high executive turnover? What's going on with their accounting treatments? Is there pressure on the bottom line? Just various things. And Enron failed that analysis. They had a meeting in early 2001 about considering that Enron was their riskiest worldwide client and should we drop them? Wow. And the memo, this all came out in their trial. their
Yeah.
obstruction of justice trial. So this memo says, it's a $52 million a year client. It's likely to be a $100 million a year client sometime soon. Let's just kind of figure out how to put more, eyes on the ball on the Enron matter. And, that was to their demise.
Wow.
Mm-hmm.
In early 2000, I'm trying to keep these dates straight. Andy Fastow came to you with a spreadsheet. Can you talk about what was on that spreadsheet and why this ultimately led to your memo?
Yes. Well, so summer of 2001, I had been at Enron Broadband, and that was an effort that was kind of before its time at Enron, and they were disbanding it. The corporation was saying, we need to put the brakes on some of this broadband endeavor. And things were really moving around rapidly. And at Enron, it was, what have you done for me lately? The rank and yank performance review. So I had two immediate offers, one from investor relations and one from Andy Fastow. And I had my qualms about going to work for Andy again. But he had been recently given the M&A responsibilities. And what he was asking me to do seemed pretty harmless. He said, Sherron, we've got a lot of assets that business unit people have told us are not strategic. They're selling them. They're not planning on holding these assets for long. This is a spreadsheet of 200 assets that are really held for sale, actively marketed by these business units. You've worked at Enron Wholesale. You've had exposure to the pipeline group. All the Enron International people. I need you to meet with all the different business unit people and determine which of these assets are really going to sell by year end. Because if it's not likely to close by year end, I got to go work some debt deals to meet our cash flow targets. Now listen to that. I got to go work some debt deals to meet our cash flow targets. That was part of Enron's demise, debt disguised as free cash flow. And that's where this listing of assets, there were about a dozen investments that were hedged with the Raptors. And that's where the math didn't add up. And when I kept digging and, trying to figure out what was going on with these Raptor structures, and they were on paper only, devised by Andy, people just really, after 2 hours, they would just throw up their hands and say, I've got to admit, I don't really understand how these things work, but Arthur Andersen's blessed it, so it must be okay.
And so these are assets that really aren't worth anything, but they're assigning them dollars.
The assets were worth something initially. A lot of them were the tech equity investments that had gone public and shot through the roof. And Enron had marked them to their highest stock price. And then, of course, the tech bust, these publicly traded tech companies had dropped. And the Raptors were these vehicles that supposedly had entered into equity, hedging transactions, derivative transactions with Enron, agreeing to buy these equity investments at their high price 2 years down the road. So it was, my first thought when I heard about it was, I can't believe the investors in Raptor have such a high appetite for risk.
Right. Yeah.
They were kind of like a put or a call. We could put these equity investments to the Raptors at a certain price. And why in the world would they enter into these put transactions with Enron on these stocks that were so volatile? And come to find out, it was just all on paper and total fraud.
And how much money total are we talking about here?
It was $500 million of losses that were masked in the year 2000. And Enron's net income in the year 2000 was just over $900 million. So on a pre-tax basis, this was 50% of Enron's earnings that were fraudulent in the year 2000.
Unbelievable. So these off-balance sheet numbers that nobody really was aware of. Did you make a decision? Did you think that this was fraud at this point or oversight? What did you think was happening here?
It shocked me that Arthur Andersen had okayed these structures.
Yeah, right. They're minding the shop, right?
And I was just aghast. I dusted off my resume. I started to interview with Enron's peer companies
Wow.
and, put the idea of a second child on hold because now I needed to find somewhere else to work. This was just horrible. But in a very short period of time, Jeff Skilling resigned and he had just made CEO earlier that year. So it told me that what I had found was really probably fraud because these Raptor structures were going to have a problem when the term expired, like in 2002 or 2003. So I first wrote a one-page anonymous letter, put it in an employee Dropbox because Ken Lay, our chairman, who was stepping back in as CEO, he had said, we're going to have an all-employee meeting to discuss this shocking revelation that Jeff Skilling has resigned. I went to that meeting. I knew I delivered a bombshell one-page letter. That's the one that said, I'm incredibly nervous. We will implode in a wave of accounting scandals. So I sat close, listened closely. Seemed like Ken Lay was saying all the right things, that we want to, do things the right way. If anyone's truly troubled out there, please, talk to the head of HR. And so that day I did go identify myself to Cindy Olson, the head of our human resources department. And she said, well, Ken Lay, probably ask around to Rick Causey, the chief accounting officer, and Andy, and they probably said everything's fine. He does better with face-to-face meetings. Are you willing to speak to him and explain this to him? And I said, yes, I am. And she said, I'll make sure he knows I know you. You've been around 8 years. You're very credible. And so she got me on his calendar for the next Wednesday. And so from that Thursday to the next Wednesday is when I had a conversation with an Arthur Andersen partner who listened to the whole details and said I was probably right. It was probably fraud. The other people gave me more information, a PowerPoint slideshow that had been given to the board, some Excel spreadsheets, so that people were wanting the truth to come out. They were wanting Enron to do the right thing. And they did give me a lot of pieces of evidence, really, to bring to my meeting with Ken Lay.
So just for context for people, Ken Lay was the founder and chairman of Enron. If I can go back for just one moment, you mentioned this anonymous memo. You originally put all your ideas down into one page. Can you talk about that decision and what you decided to include, what you decided to leave out, but most importantly, why did you decide to do, at least initially, not attach your name to that memo?
Well, it was a pretty knee-jerk reaction. We find out Skilling quits Tuesday at 3:30 after the markets close.
Yeah.
And I typed it up, Wednesday. Just,
Wow. That quick.
And remember, I've got some interviews going. I'm trying to, find another job. I've been worried that we had committed fraud for a couple of weeks now, so it's been on my mind. And so I put all that down and where I thought the problems were. And I was really wanting him to, hire an outside law firm, an outside accounting firm. Now, I really wish I would have taken a breath and just tried to find others to go in and meet with me. Also, Jordan Mintz was an in-house attorney that worked for Andy Fastow. And it came out later in all the litigation and discovery that he had been very concerned about these structures, and he had broken the rules at Enron and hired an outside law firm, Fried Frank, to look into it. And that law firm had told him, no, this stuff is just totally bad, totally wrong, wouldn't hold water. So if I had found Jordan and that report, and the two of us with that other legal report in hand had gone to Ken Lay, possibly he would have listened to us. So I should have put out a few more feelers and found, because look, that evidence was just right there.
Did you believe Ken at this point? Did you believe he was being sincere, that they really were looking to address problems?
Yes, and there were a number of things that he did that would make you think that.
Mm-hmm.
So they were asking all the employees to go to this link and fill out this anonymous survey. asking questions about the company. It was kind of cutesy, but his name is Ken Lay. So we came into work in early September, and they're handing out bags of Lay's potato chips with a little placard that, was like, nutritional information. And the nutritional facts were something like complete and honest feedback, totally anonymous and confidential. We want to know what you're feeling, what you're thinking. And so that was a huge effort at getting, truth known. So you get this feeling that, okay, he's realizing things aren't right, and he's trying to find what's gone wrong within the company under Jeff Skilling's leadership.
Yeah. I guess at some point it became clear that they weren't going to do the right thing. Can you talk about what happened that made you realize that, Arthur Andersen's not there to cover, they're not going to step forward. Nobody else that you've reached out to is going to step forward. Can you talk about how that felt at that point?
It was similar to you starting law school September 10th. I spoke with V&E on September 10th.
Yeah, a private law firm.
Yeah, their primary law firm that had really helped to bless some of these structures. But I'm still going to give it my best shot. So I have this long meeting with them, and then the next day is 9/11. And that really distracted so many people from anything. My hiring efforts outside of Enron were put on hold. It was just what's happening in the world now. And I was still trying to, hope that Enron was doing the best. But, I wasn't queried again after my first interview with V&E. And that's when I was moved down to the 16th floor, cruddy little office, no real work to do. And I started to get very suspicious about what was going on, because the jobs that were offered to me would be beneath my skill set, beneath my position, and working for someone that was basically like the best friend of Rick Causey, or someone like, it looked like a setup to fire me or something. It just was, It was just not good. But I still kept trying to talk to different people to get them to understand what we needed to do. But at the same time, behind the scenes, the wheels were coming off at Enron.
It came off pretty quick. Yeah.
They decided to write off these Raptor structures, and that was announced mid-October. So it still baffles me that, Ken Lay, maybe he was asleep at the switch CEO, but some of the executives that were under him that were now in leadership positions, they should have known better. October 16th, they announce, we've met our earnings. Yay, everything's great. Everything's wonderful. But, oh, by the way, we do have a non-cash write-off. We're adjusting shareholders' equity by $1 billion down. And we're, one of the write-offs is a $544 million non-cash, non-recurring unwind of a previously disclosed related party transaction. Remember, $544 million is half of the earnings from last year. Like what? Yep. And how can something be described as non-cash, non-recurring unwind of a previously disclosed related party transaction? Andersen told Enron this was not something that could be a current period write-off. It has to be a restatement. But the next day, October 17th, 18th, and 19th, the Wall Street Journal hit Enron with expose articles, front page articles about Andy Fastow, his related party structure. They didn't have all the facts, but they were really exposing some of the rot at Enron. Those articles helped start an SEC investigation. By Friday, October 19th, the SEC announced that they were doing an informal investigation of Enron's financial statements. And that's what really started this quick demise, where Enron was trading about $33 a share. And by the end of November, it was in the pennies. It didn't take long.
This is a fascinating story. I found a lot of these articles back from October 16th, the 17th, 18th, and 19th, all these stories breaking in the Wall Street Journal. The interesting thing is, here we are 20 years later, a lot of the stuff still happens. But thankfully, because like Sherron was talking about, Dodd-Frank has these SEC whistleblower protections and incentive program. This whole Wall Street Journal expose is sometimes bypassed, and the SEC gets involved without this kind of public scrutiny, which sometimes is a very good thing, right, Sherron? Allows the SEC to investigate without a big shredding party, which I believe may have happened here too.
Well, and also I think now with Dodd-Frank, someone like myself, I would have reported the 96 things, so people will report the things. And the reason I say that, back in the 90s, you really didn't have, the internet was really just getting going. Yep. And the main page, if you wanted to talk about a company, you went to Yahoo's finance page under the company's ticker symbol.
That's right.
And that's where you would see a big chat board, and that was really the only place for a chat board about a company's stock. And there would be, what looked like Enron employees, their handle would be Enron Waterboy or something like that. And there were really warnings that be careful, this is a house of cards, Enron's executives are going to go to jail one day. And so there were other people other than me in the company upset. So there would have been maybe multiple people going to the SEC and earlier, so hopefully this stuff was stopped. I wonder about the 2008 Wall Street crisis, because there were whistleblowers worried about the subprime mortgage business. They blew the whistle and they were fired, and they filed SOX complaints, but just didn't get anywhere with them, which is part of the reason why we have the Dodd-Frank provisions.
That's right.
But, perhaps the Wall Street mess could have been prevented had Dodd-Frank been in place. So I think it's a wonderful check and balance that really works for the health of the system. And the U.S. Chamber of Commerce and the Business Roundtable should stop lobbying against these whistleblower protections.
Yeah, it's so interesting in talking to people over the years. I think a lot of people that step forward as a whistleblower is that they view that their company that they're very loyal to has been hijacked by one or two people who are driving the company off road. Sherron, so this term whistleblower, I know that this is a term that has evolved and changed. When I started in this world, it's a term that we sometimes didn't use. I used the term truth tellers, that these are the truth tellers, because I didn't like the term whistleblower. What are your views of the term whistleblower?
Well, I think it's starting to improve. It's certainly, normally it was synonymous with rat, fink, snitch, tattletale, but it actually is starting to be a bit more positive. Some of it was with the governmental whistleblowing to the inspector general's offices that happened, in the last few years. Some of the, there's big whistleblowers like, Edward Snowden, Reality Winner, that people are behind their causes and champion that they help stop abuses of power and wrongdoing. So I think the term is changing. But it's problematic. I mean, it's been 20 years since Enron, and I had high hopes for a career consulting boards of directors and insurance providers of D&O insurance and things like that. And I was pretty untouchable. Right about now is when it's washing off, and and it appears that I will be employable.
Wow, 20 years. 20 years. You just to round out the story for everyone that's not aware. So we mentioned Andy Fastow. He was sentenced to 6 years, served 5 years, forfeited assets valued at 23.8. We talked about Ken Lay, guilty of 10 counts of securities fraud, and then died 3 months before sentencing. And of course, the company filed for bankruptcy, and Enron no longer exists. And Arthur Andersen was criminally prosecuted. Here we are 20 years later, and things have changed by and large, I think, for the better. What else needs to happen to ensure that the next Enron doesn't happen?
I mean, looking at it from a 40,000 foot level, I think the problems within our system are our overuse of stock options. It's taking us down a different discussion path today. But back in 93, we passed a law in this country that corporate salaries above $1 million could not be deducted on corporate tax returns.
Mm-hmm.
And that had a very negative unintended consequence that by that point, CEOs were making $3 million, $4 million in cash salaries. So those were lowered to just below $1 million, but now you had to make up the difference. And so that was done in stock options. And stock options are not worth anything the day they're granted because the option exercise price is the current stock price of the publicly traded company. And usually they vest over time. You have to stay employed by the company. The company stock price has to go up. You can't, the market could have a collapse, something else could happen. So if you're trying to make up $2 million in cash, you give an executive $5 million worth of stock options because of all the time value of money and risk inherent in actually those stock options being worth $5 million. And so the consequence of that law was that, like in 1990, CEOs on average made 82 times the average hourly worker in America, 82 times. By 2000, CEOs, not the C-suite, not the C-class, but CEOs in this country made 531 times the average worker. Yeah. Most of the analysis right now will tell you that the C executives, CEO, COO, CFO, make in the 300s, so they make 300 times above the average hourly worker. And most of that compensation is coming through exercising stock options. So stock option use is exorbitant in the US versus Europe, Japan, Canada. Those countries, their CEOs make 10 or 20 times, average hourly worker. But the problem with that is once the high executives have stock options, so do the rank and file employees. And that makes everyone avoid bad news. Nobody wants to recognize a problem and correct it because that could tank the stock price and their stock options would now be worthless, or it's going to take a longer time for them to be worth anything. So that is a big problem, I think, that drives gamble the company behavior. It drives avoiding recognizing problems and getting them corrected. So if we were to do anything in this country, I think we should focus on stock options and their use.
Wow. Thank you for putting that on our radar. I really appreciate that. Sherron, so you talked about, this, so you stepped forward, you exposed what was happening here. And then in this next act, you've been telling this story for many, many years in different speaking engagements and inspiring people, would be or should be whistleblowers to step forward. You've inspired the next generation of whistleblower attorneys like myself. And now you're talking about, you're now employable. What is the next act for Sherron Watkins?
Well, I am teaching corporate governance, ethics, and leadership. So I do a weekend course at UNC Keenan Flagler's school, and I'm soon to be the executive in residence at Texas State University, teaching ethics there and doing some student mentoring. So I'm excited. I'm jumping into academia.
Professor Watkins. That's very cool. That's very cool. Well, Sherron, I really appreciate your time. I just want to acknowledge you for having the courage to go against the tide when it seemed like 8,000 fish were swimming downstream and not doing anything. You swam upstream and pushed against what was an obvious fraud scheme. But I appreciate everything that you've done for our country and moving, really being the impetus and the driving force for some really key legislation that's going to protect future whistleblowers. So thank you so much for all of that.
Well, Jim, thank you for the work you do, and thank you for having me on your program today.
Absolutely. Well, guys, if you're looking for a book to read, Sherron put out a book in 2004 called Power Failure, The Inside Story of the Collapse of Enron. It is a fascinating read. There's lots of books out there about this, but Sherron's story is the one that you certainly want to read to fully understand what happened here. Next week, we're going to take another dive into a little different area of the law and whistleblowing. I'll keep that a secret for now. Make sure you join us next time on the next episode of Fraud in America.
If you believe you've witnessed fraud against the government at your job or want to learn more about these important laws to combat fraud, visit fraudinamerica.com. On our website, you can find whistleblower lawyers, logs from these expert attorneys, and more. You can also find a transcript of today's show notes, a way to contact our team, and a way to chip in to make sure we can keep bringing you the latest on fraud. This episode was edited and produced by Rachel Brooks, and our theme music is by Connor Chaos. A big thanks to our staff and researchers of Jeb White, James King, Emma Bass, Jackie DeMar, Kate Scanlon, Brian Markovitz, and Max Boltman. You can learn more about them at fraudinamerica.com/team. Fraud in America is a project of Taxpayers Against Fraud Education Fund.